transaction, the guy in here, United States, doesn't understand accrual-based account. He was using a purely cash-based accounting. So I wrote a 2-page brief and filed with the New Jersey court of New York, and we will be hearing from the soon about the outcome of that brief. By the way, I don't charge that much money. No way. That 2,000 is a high-flying figure. The next thing, we all, well, to some extent, we know the difference between not just get and this. Example of this is rule-based and pre-protection. How the stock market and IFRS, which set of financial statements will contain more information, content, therefore better reflect true price of your stock. Just guess. Just guess. The hint is there is no answer. One here, the bunch of research says this convey strong information content. Therefore, stock market react much better with IFRS. Some group of research papers, tons of papers also here. Well, that is not the case. US GAAP is as good as, sometimes better than IFRS in conveying the information content. What do you think? Look, that's why I gave one example here. Column, 9 column.
Gaps has more information,
More information.
so that would, in theory, make it better.
This will be more information, assuming people outside doesn't know about the content of this, right? If they don't know what that is, yes, they provide more information. If everybody knows this, this might be information overload. Yeah. Did I agree? I think I agree. $109,894 World Annual Report. Wall Street Journal cover. See, General Electric 10K annual report is longer than the Great Gatsby. The Great Gatsby. The masterpiece. And it's longer than Ronald Dahl, Charlie and the Chocolate Factory, George Orwell, Animal Farm, the Pelican, what's that?
Brief.
Yeah, Pelican. Hamlet. The Pelican at the Shakespeare, a Hamlet. Now, annual report is longer than this masterpiece, literary masterpiece. Annually. So how much you have to read in order to understand one company financial? This is a leisure book. You can read and enjoy this book. Annual report? Forget about it. Some of the footnote, it took me several weeks to make debit and credit. Yeah. It's not fun reading. And it says, average Joe will never find out what's in NK. And they keep adding. Dumping. And on top of this, right after this, well, this is June this year, June 2nd. And this is when? August 20. And it says, one of the, I think I mentioned the other day, here, look, if there is a lawsuit, because that is because of the quarterly EPS. They are overstating and understating. Why don't we do the following? Why don't we get rid of the whole quarterly reporting? Yeah. There daring idea and quarterly report. Stop filing 10Q with SEC. Too much data, too much information. Same thing, too much. The only way to keep up with. Now, textbook, accounting textbook, coming out every other year, if not every year, because there are so much changes in GAAP accounting. It used to be 5 or 6 years, and then you have accounting book to replace all the examples, not anymore. Every edition contains new information, and that's the only way to keep up yourself with the current changes in accounting. Now, Cisco financial statement. Now here, goodwill purchased intangible asset. What about internally developed intangible asset? I mean, intangible asset can be purchased, yes. That's why they are here. We are paying $3.4 billion up to today to purchase a other intangible asset like copyright of other company. Patent. Most likely patent, Cisco. What about you develop your a patent, intangible asset? What is the accounting for internally developed intangible asset? How is it?
Research and development costs, they would put under the
R&D?
yeah.
What is the current accounting for R&D? That's it too. Current account. Merck spent $5 billion R&D this year. Where they put this $5 billion R&D? Expense. So internally developed intangible also don't show. I mean, that's the purchase intangible. Same intangible, patent. Either you develop, purchase, same different. Jason, what's going on here? Purchase intangible asset, patent, right there, $3.4 billion. I developed this patent, $1 billion, but that's not there. And two, here, Mario and Lydia suggested it should be expense right away. Why there is asymmetrical treatment for the same item? One is purchased from Intel. The other, I developed this, spending as much money as this.
But the internally developed, like intellectual property or in like medicine or something, should be historical cost based. Because you spend, if that is for sure, that will go to us.
If that is sure.
Yeah,
Okay, if that is sure. In other words, you are developing this patent. At some point, current rules say you have to expense it. Everything has to be expensed. At some point, you know, yeah, viable, you know this is commercially feasible. At this point, I know I will have successful patent. At this point and on, this will be capitalized. And this is also same for software. Software development, up until here, you have to expand. But once you develop software and you know there's a market for this, market for pharmaceutical products, patent, then commercially feasible point, once you have to document. You have to document. Why we don't capitalize this? Why as soon as you R&D is expense. By the way, in Japan, most of the R&D is an asset. But here, FASB number 2, R&D is an expense. How come we don't treat R&D as an asset? Well, the Merck, you make R&D expense debit $5 billion. This will kill it. Not a Merck because they have huge income, but for most other companies, for major R&D activities, that will ruin your income statement. Actually, that will discourage R&D activities. So every time I do brand new R&D activity, I have to absorb huge amount of R&D expense. That decrease my income, EPS go down, market also share goes down. Uncertain. From product idea, testing, collecting data, testing on limited animal subject, limited human subject, general public test, documentation with FDA, get approval, 10 years need, 10 years. Who knows what's going to happen in 10 years? As the argument is, since there is so much uncertainty as to how much of a $5 billion work R&D will be unsuccessful, 100% expense. So this mismatching is imposed by US GAAP. US GAAP actually say mismatching gap. That's not company fault. That's the Financial Accounting Standard Board fault because they don't know how to measure it. Mismatch. The key idea here is when over this time period, when this idea became commercially feasible. That is the key test. Well, we all know this. Considerable amount of assets, we talked about this. New technology asset and well-designed supply chain. Current financial statement. The current financial statement has all the backlog. In other words, I keep producing. Customers are lining up. I have all the backlog for the next few years. I don't have to worry about marketing costs. People are waiting for my product. All the backlog. Is it assets? Is it liabilities? Equity? Capital? What is it? Rebecca. Someone is craving for your product. You don't have to do any promotional, any advertising. All you have to do is simply produce it, and they will buy it as soon as you produce. Current financial statement doesn't have that information. Balance sheet, we look at balance sheet after balance sheet. We don't have this on the backlog. What is this? Is it? What is it? What is this? Yeah, but what you don't have to worry about other expense, and you have a guaranteed cash flow. It's not asset, but stock price will incorporate this information. Well, they don't pay marketing expense. Save the expense will increase future cash flow. Stock price is discounted future cash flow. Stock price will go up. Go up.
How would you know about that?
Oh, footnote information. Footnote.
Right?
Footnote information. Yeah. They make a voluntary disclosure on the footnote. Yep. And industry information. Industry knows which type of industry and which company has knowledge-based assets not here. Now Disney. Brand asset is not here. Brand asset is not here. That is most probably this is the most expensive asset on their balance sheet, right? They don't have to. Liability and stockholders' equity. This liability, we need to. Well, let's do this. Go briefly. No, well, I don't think we have many items here. accounts payable, fair value, current value, current value, accounts payable, trade payable, accounts payable. How about estimated liability? What would be example of estimated liability? It is a liability, but you have to estimate. Example of estimated liability. Hmm?
Have a court case.
Oh, court case. See, this is a contingency and commitment, contingent liability, right? Legal liability. You might be losing big money because someone is suing you for a patent infringement. Intel and Texas Institute. I don't know who paid whom, but there was a $1 billion settlement between these two. Let's go here. Estimated liability. This is contingent liability. Similar, but here, what is the estimated liability that you can easily find from your income statement? Right? Estimated liability. Exactly. Warranty liability. See, warranty liability. In other words, if I sold 100 units of Harley Davidson, I know based on my past experience, about 5 of them will come back and I have to service them. Labor plus profit. Estimated liability, warranty liability are measured at quasi effect. Just like account receivable. Quasi. How about bond payable? Historical cost plus minus amortization, bond payable. Contingencies. This is a good example where we can see accounting theory works. Here, let's assume this is a loss contingency and this is gain contingency. Probability. In accounting, we have 3 different probabilities. Probable case. In terms of numerical percentage, if I say probably we'll have a rain this afternoon, what kind of percentage are we talking?
Greater than 50.
Greater than 50. Okay, probable. Mario, would you change your percentage if I say next category is possible?
Greater than 60.
No, this has to be higher than this one, right? This is 60 now, this is
20 to 50.
20 to 50. Okay, I like 20 because 20 will be remote possibility. Remote possibility is less than 20%. So, Sean, how much for this?
20 to 50.
Oh, 50, okay. 50, between this range, right?
Mhm.
So for probable case, how much?
50 to 100.
50 to 100. Pick one number, please.
75.
75. Let's round up. 80. In accounting, if chances are more than 80, we say it is a probable case. Possible, half and half. Remote possibility, less likely to happen, less than 20%. For loss contingency, if case is probable and you can measure extent of damage loss, then you have to make adjusting journal entry, and this has to go to financial statement as debit, legal expense, credit, contingent liability.
Probable and measurable, right?
Probable and measurable. They say annual between $1 billion to $1.2 billion is a damage. You have to legal counsel suggest, and that the case is probable based upon past experience, and adjusting journal entry, actually you have to make a journal. It didn't happen yet. It might happen June this year, but as of December 31st, you have to make this journal entry because legal counsel advised this is probable case and we know damage will be this much. What about gain contingency? I know I will get, the other guy, I know I will get $1 billion, more than 80% chance. What is the accounting rule say?
Nothing.
Only recommend?
Nothing until it's realized.
And they say, show me the money. I mean, he didn't get the money yet. So this one, footnote disclosure allowed. If you want, you can disclose, but they discourage. Yes. Why? I mean, same case, probable case, measurable case, between loss and gain contingency, financial statement impact will be different. For possible case, what is lowest possible case here? Footnote, disclosure, encourage. Look, disclose. This is where contingency and commitment, all the way at the end of the corner of your financial statement. It's funny. If you go 10K and go probably, most likely, the last footnote item is contingency and commitment. You know what they say in fine print at the corner of financial statement? We probably be losing $2 billion. You kidding? $2 billion? 80% chance? And at the end of the footnote with the fine print, debit legal expense $2 billion, credit payable $2 billion. Not allowed. Disclosure, either way, not allowed. Why this symmetrical treatment? For loss, as long as you find out it's probable and measurable, you recognize financially and recognize it all the way. For gain, footnote barely allowed, and here encourage it, and here not allowed. You don't have to disclose. Why this asymmetrical treatment according to accounting theory of
Conservatism.
This is a conservative network. In other words, same case, but between loss contingency and gain contingency, a different treatment. Liability, all different valuation techniques. What is the definition of current maturity of long-term debt? We know principal portion of long-term debt is due within paid within 1 year. Describe more for us to go ahead with the structure of that. What is the how you get that current portion or current maturity of long-term debt? What is that?
Well, it has to be paid within 1 year.
Within 1 year, out of where?
I'm sorry?
What is the original? What is the original obligation? That is coming from where? Current portion of long-term debt. This long-term debt, and this is from which debt? There are two different debts. Installment debt and a term loan. Here, term loan, and installment loan. Term loan and installment loan. Where this current maturity of long-term debt is coming from?
It's less than 1 year, so terminal, I would assume, or it's...
Yeah, well, installment loan is this, 10 years, 10 million, every year you have to pay 1 million. So first year, $10 million interest plus at the end of the first year, you have to pay $1 million principal money. So second year, you pay again 1 million, so $9 million outstanding. $9 million interest plus $1 million, $8 million interest, and $1 million. So last year, $1 million outstanding for interest on $1 million. That's an installment. So right here, current maturity of long-term debt is $1 million, right? So this is from an installment loan. What is a term loan debt? If you borrow $1 billion and you have to pay term loan at maturity, $1 billion plus accrued interest. How many of the firm can come up with $1 billion cash right away? Plus interest. How company deal with this situation? They borrow. Oh, by the way, according to my database, Fortune 100 company average borrowing per year, if they borrow, $2 billion. Go to Verizon. Do you have any? Do you know how to use smartphone very fast? Go to Verizon financial statement and find out how much they have long-term debt. Scary. Now it's more 40, $50 billion. That's why they ask for saving every day. You get the email, the promotion. You sign up $300 a prepaid card plus, but you have to commit 2 years. Why? They need to service that $50 billion. You need huge cash. Term loan. How you pay that $2 billion? Let's say this is a 15 years. You just do investing and everything, and you realize that you need $2 billion by the end of the year.
Verizon has $109 billion in long-term debt.
109 billion.
109 billion.
Now 50 billion was a couple years ago. $109 billion.
109 billion.
How much is their sales or their asset base?
Total assets 240 billion.
But total assets is underground, cable, all this subject to huge depreciation. Total revenue for the year?
Total revenue 32 billion.
$32 billion, and you have over $100 billion debt? Thanks for the good news, Sean. That's a really great news. I just switched over to Verizon, you know. Hope they are around a long time. I think, let's say 5% loan, $100 billion, 5%. How much is the annual interest expense? $5 billion. $5 billion interest expense. So term loan, you don't wait until last moment to come up with $2 billion.
You refinance. You constantly refinance.
Exactly. Constantly refinancing, and then even with the refinancing, you have to pay back and repay. So that's why they end up with more than $100 billion. But at some point, you have to pay, right? So here, $2 billion. Board of directors will say, "Oh, this is a 30-year, $2 billion. 2 billion divided by 30. 30. Well, that's not exactly 4 years. Let's do 4 years to make our life easier. This is 4-year loan, 2 billion. How much they need per year? 50 million.
500. Oh, 40. Okay, I think it's 40. Yeah, 50.
50 million, right? 40 years, right? 40 years. Is it 500 million or 50 million?
50.
50 million. Now, term loan, 2 billion. In order to pay 2 billion they will save 50 million, and board of directors will say, no matter what, you have to set aside $50 million cash in checking account, and this classified as restricted retained earning. Restricted retained earning, you can pay dividend out of here. You must save $50 million, and we say this $50 million 39 times and 40 times as sinking fund. You want to sink down your debt by saving $50 million. It's like current portion of long-term debt, but you don't have to pay, you have to save. And this is a board of directors action item. Someone says, I have cash $5 million. And you say, oh, they don't have any problem of a liquidity problem, solvency problem, $5 million cash. Would you believe 80% of that is a sinking fund that you cannot touch? Yeah. That's another item that you will have to do. Liability Cisco. Now we know better with discussion income tax payable, accrued compensation, deferred revenue, other current liability. We know now we all know operating cycle, cash cycle. Now how you compute number of months or number of days of operating cycle using balance sheet and income statement? Anyone? Just we all know the basic ratios of how you compute operating cycle. Okay. Operating cycle is cash cycle. You purchase, and for merchandising and manufacturing is different. And let me give you a manufacturing case. You purchase raw material, and then raw material you make application of overhead and labor. That will be working process, and you have finished good. Once again, you add a overhead and labor, and then this will be transferred to marketing department, and marketing department will have to make a sale, and then you have account receivable, and you have cash. So this is a cash to cash cycle. They say operating cycle, and this is a manufacturing. But for a merchandising, instead of this, you have simply purchase. So we'll deal with the simple case. And purchase, and you have a sales, and you have account receivable, and you will collect a cash. Yeah. Now looking at this, a cash cycle for merchandising, we'll deal with this in cost accounting, management accounting. Here, how would you compute a this cycle, this number of days here? How would you compute this number of days? In other words, from income statement and balance sheet, we can find out number of days it takes from cash to cash. That's the operating cycle. We can say, okay, 1 year. Less than 1 year, current item. More than a year, non-current item. We don't say that because financial statement explicitly contain those information, and current, non-current will be decided by number of months, number of days. In this case, more than a year. In many cases, in this case, most probably few months, 3-4 months. Therefore, 3-4 months operating cycle or 1 year, whichever is longer. 1 year is longer. That's why for merchandising we simply say a 1 year. Now, for this cost of goods sold over average inventory will be inventory turnover, and 365 inventory turnover is number of days to sell your inventory. So for US merchandising, average is 6 inventory turnover, meaning what do I mean by average inventory turnover is a 6? What does that mean? 6. What does that mean?
So you inventory 6 times a year?
6 times a year? Average balance of inventory will be sold out 6 times a year. That's what it is. Therefore, if I do 360 over 60 days, how many months I need to sell average balance of inventory? 2 months. So you probably give out invoice term to your client and 60. 110 and 60. 210 and 60, depending on the correct term. 110 net 60. What do I mean by 110 net 60?
5% discount, then you're even on the rest.
You got 1% discount, otherwise full payment is due within 6 days from the date of
Receipt. Where's that?
invoice date. Invoice date, yes, close enough. Now, for that is this. For that is this. So this is sales over average account receivable, and that is account receivable turnover ratio, and 360 over average account receivable turnover ratio, and this is 9 US industry, retail industry average. So this will be 360 over 9. So this will be 40 days. In other words, here, your operating cycle from here to here is 60 days and 40 days. 60 days and 40 days, 100 days. Slight more than 3 months for merchandising company, which is getting shorter and shorter because of computerized system. They pay through internet, you know, not anymore like check. They simply do this with the website. Now for manufacturing, this might be more than 360 days. So that period, because this process can be complex and longer, because we have to make. California wine industry, they store wine for 7 years before they go to market, for example. Any assets and liability whose life is less than 7 years will be current asset, current liability. 7 years. How many statements I use for this? Income statement and balance sheet. How many items I use? 2 items from income statement, 2 items from balance sheet. And I know the efficiency of the company compared to industry average. One important measure of efficiency. What if you are collecting, industry average collection period is 60 days. You are collecting your account receivable within 40 days, like this. Oh, you are very efficient. What's the downside of that efficiency? Everybody else is giving 2 months, you are giving 40 days. Very competitive environment. What's the risk of doing that? Well, because
Your credit, you're so tight with your credit, you're not getting paying other people.
yes, you might be losing customers to rival company because you don't give enough credit period. Look, for this, in other words, efficiency is a double-edged sword because Yeah, it's good to have efficiency, but at the risk of losing your clients? Probably not. 210 net 30. I will do this. 210 net 30 because it's most popular first. The transaction term will be COD, cash on delivery, because I'm new to the business. I don't have credit history. COD, then EOM. I don't care what when you purchase. End of the month, you must pay. End of the month, EOM. COD, EOM, and 30. You have full 30 days from the date of invoice. Then 110 net 30, 210 net 30, and 60. You have full 2 months. In that order, as you compile your credit with your clients and suppliers and vendors. 210 net 30. 210 net 30 is this. If you pay within 10 days from invoice date, you got 2% discount. Otherwise, full payment is due within 30 days. This is the 10th day, and this 10 days and 30 days. So here we say this is discount period. Discount period, and for this one is credit period. When you get discount, when you take advantage of this discount period, what day would you pay? Here?
Day 10.
10th day, right? Because there is opportunity cost of cash. See, if you pay here using that cash within this period, you can use that cash for your operation. If you don't have money and if you don't take advantage of this, you can take advantage. You will pay on the last day. So the 20-day difference, accounts for 2% return. If I take advantage of this credit term, 2% per year, 360 every 20 days. Every 20 days here, keep purchasing, and 36%. For the average balance of accounts payable, I will be making 36% return. How many of your investment on 36%? Not many. That's why it is always advantageous to take advantage of discount term. Here, what is a simple operating cycle for MBA, other MBA class here? I don't go that way. I simply do basic diagram here, not this class. After this class, after this program, your friend and family and everyone else will ask accounting questions because you are an expert, master of accounting. We need to go deep down. Whenever I use this, I really appreciate my edge. I'm not suggesting anything. No. This is a gift from who got 2 promotions after the graduation. He was a CFO for the company. And someone was asking for good accountants. I told him, look, there's an opportunity there. And he said, Dr. Kim, I just got a promotion. I'm a CFO now. I can't do it. Good for you. And he knew I was always going back and forth of doing this. And then he went to Amazon.com, he went to Amazon.com, and I found this in my mailbox. Not suggesting anything, don't get it wrong. Long-term debt and other long-term liability, and here we dissect all these. Now, the contribution attributed capital, the common stock and APIC. This is retained earning. Well, we all know this. Now, AOCI. Yes. Up to here, we know the accounting. What is the journal entry for treasury stock? Anyone? Debit? When you buy back your own stock, debit? Treasury stock? Credit?
Cash.
Cash, yes. I like this. In MBA, in order to say this, I have to spend about 15 minutes. Why? First, why they buy back? And what happened to your income? 15 minutes. Here, what's the journal entry? Debit treasury stock, credit cash. AOCI. AOCI. Let me show you a brief. See, well, it's junior faculty now, I include him. But Edina Convex is undergraduate student years ago. This is 2007, I think. Edina came from Budapest, Hungary, international student. Right student. Undergrad. She came to me after first day of class, Dr. Kim, I want to do 1 year, 6 credit, 2 semester, a research project. I have some electives, I want to do some research project. Okay. Back then, this AOCI just came into CAP. So why? I said, why don't you pick up Fortune 100 income statement? Go to website, income statement. Look at where they disclose other comprehensive income. My prediction is they will disclose other comprehensive income in income statement boldface. If they have other comprehensive losses, they will go to all the way corner of stockholders' equity balance sheet as little as possible. Find out 2 years of a Fortune 100 company disclosure practice, and that's exactly Edina Fund. I helped her testing this data collection. International Journal of Business and Economics accept the manuscript as it is with some editorial changes. International students cannot have a full-time job in this country. She was the exception. She has this publication. When she applied for KPMG, she has this publication on hand, undergrad students. Forget about the PhD students, doctoral students. If they have one publication, they are lucky in the job market. Undergrad students. And I signed this and send it to the Edina. Look, submit this and make sure you make this bold-faced item in your resume. And now she's in Chicago, KPMG Chicago. That's exactly what we find. 95% of the time, they will brag about their income because that's the game option. And 95% of the time, if they have other comprehensive losses, the classification, that's data collection. 95% of the time. See? 95% of the time. If they have a losses, they try negative, positive. journal like this outcome very much. Even with this simple test, they accept this article as it is. And this is exactly that the AOCI that we are talking about now here. Here, AOCI. Now it's been around what? It's been around 1997, 97. So it is about I don't know, 15, 18, almost 18, 19 years, close to 18, 19 years. Now, in good old days, stockholders' equity is this. Asset minus liability is a stockholders' equity. Residual claim. If you look at format of income statement, the balance sheet, asset side, left-hand side, the asset, after you pay back creditor, then what's left? Residual interest is equity. Now, residual used to be most simple part of financial reporting, not anymore. This stockholders' equity section became dumping ground by FASB. Whenever they don't know the answer, they included it here. Here, 7, 8 major items inside here. And they show only one net amount. Net. Look, you have $1 billion loan and $1.1 billion comprehensive income. If you net, you forget about 1 billion income or 1 billion losses. You simply show 100 million income here. We have to dissect what's inside. It's not enough to say, okay, we have one more item, and net amount of AOCI is this. AOCI, Cisco AOCI, I can guess this could be stock options, pension adjustment, or international business or foreign currency translation adjustment. Most likely they will have this from the non-controlling interest. Well, it's almost negligible, 8 million and 15 million, but they were kind enough to show non-controlling interest. We'll take a look at the non-controlling interest very carefully. Here, you must set aside income attributable to non-controlling interest, and this is net income to parent company. So if you add this up, that total, this net income here, those net income is consolidated net income. Consolidated net income, C and I, has a two components. Net income to non-controlling interest, income to controlling. Parent company will be controlling. Apple, $156 billion revenue. 156. So cost ratio 87 over 156. Cost ratio and a gross margin ratio was very strong. This is how about 68 over 156 is about what percentage? 40? About? Yeah, 40%. Now, after you pay all this employee and everything, it's a percentage of this operating expense, common size. This is what? 9%? 8% of this? And then 8.5. I was close enough. 8 or 9, 8.5. Now net income is 41. Operating expense, operating income. What is this percentage here? 30%, right? 30, about 29, 30%. And this one, 35. 35, and this one. In other words, this two percentage is less than is about 30. 26.
Yeah,
26%. So for Apple, for $100 sale, 26 is the net belongs to shareholders. Wow. Yeah, 40% gross margin and 20% is net margin. We don't see this type of a lucrative business only in high tech. And they are making all this, would you believe? They are not using their own investment money, they are using someone else's free cash. Even better. Yeah. Now, this is what's coming up. You will see, if you go to FASB.org, if you go to FASB.org, FASB is proposing new format of financial statement to be consistent with international financial reporting standard. Year 2014 and 15, we are supposed to be using all these fair value and new financial statements here. If you go to FASB.org, go to there a discussion memorandum. Then one of the memorandum talks about new financial statement. New financial statement, current financial statement is cost of goods sold, gross margin, SG&A, and then operating margin and tax, and this is net income. That is current format. Now they say, okay, we'll do here payment to cost of purchase, and here personnel cost, and maintenance expense. In other words, they are proposing income statement based upon function of each activity instead of this. This is a stakeholder approach. You pay what? Supplier, you pay employee, you pay government, and this is what's left. Here, sales minus how much is the cost of purchase, how much is the personnel cost, how much is the maintenance cost, sales expense. All this depending upon function. Now, according to FASB and IFRS, income statement balance sheet prepared in terms of function provide more value relevant information to the market, which is the truth, because we don't know what's in here, right? Yeah, this is what beginning inventory purchase minus ending inventory, but then you have to add the transportation in. Transportation in includes 4 or 5 different items. How you find out here? At least here you have expense based upon function. They propose this wholesale change to the format of financial statement. I don't know when they will adopt. I think this will go together with IFRS. Someone is lobbying hard against this. It's like IFRS. From now on, for our purpose, investor point of view, user finance, we'll classify all assets and liability, expense and income to operating and non-operating. Since we have this format, we don't know which one is operating, non-operating here. We have to reformulate. Reformulation of financial statement, which is current financial statement into operating, non-operating. Why? Well, this is a core expense, non-core expense. Operating revenue, core revenue. Stock market react to core revenue, not one-time item, unusual item, non-recurring item. Therefore, knowing how much of their operating revenue, operating expense is a critical for our use here because we will then challenge these stock prices. So here, okay, that's the income statement. I said income statement is subject to mismatch, R&D expense. See, I didn't know Cisco is using $5.9 billion R&D. What kind of R&D activity do you think they have? $1.6 billion? Yeah, well, they have $38 billion, well, here, $48 billion revenue. But this, to me, compared to their revenue, this is a huge. 6, 1/8, about 12.5%. 12%? Yeah. For every $1 saved, $100 saved, $12 is R&D. What kind of R&D activity you think they have? Why they spend that much money? I mean, do they have too much income and therefore they want to reduce their tax obligation by crediting that, charging that much of R&D expense to the income statement? Michael, for Cisco, what kind of R&D activity?
Well, I would think to make sure the business they're in IT.
IT.
So they have to develop different types of servers and that kind of stuff.
Yeah.
So it's a very, not like you just focus hard on it. And that's wrong. You have to continually innovate. And that's why you have a lot of ideas.
Yeah.
And the product stream, you know.
Server, software, and router. Router, Cisco has absolute advantage in that market. Cisco router, you can beat it. I mean, this is a worldwide domination by Cisco. And you want to improve and improve because here, I mean, if you have that kind of patent and dominate market share, you want to keep investing in that area to have increased market share. So this is a US GAAP imposed mismatch. We know if they spend this so much money, some of them will increase future cash flow. But here, FASB number 2, 1973, says we don't know the outcome of R&D, 5.9 billion. Why don't you expand? So FASB imposed this mismatch. What would be other example? Rule imposed mismatch. You can't blame the corporation. You have to blame FASB. Film production cost. You can capitalize. Everything has to expense until you bring revenue because there's so much uncertainty about the movie. It can go blockbuster and it can go downside. You might not be able to cover your cost with the movie. That's why film cost, R&D is 2 examples of US GAAP-based mismatch. What would be mismatching practiced by each corporation? I mean, this is bad enough. This is bad enough. But on top of this, each company will use mismatching in order to advance their personal, not corporation advance. For managers, they want to increase income by mismatching in order to keep their job, to keep their stock prices, to keep their stock option value. What would be a mismatching practiced by a corporation? Just simple example. You all know it. I think mismatching this term is used as confused. What would be practiced by corporation? I have a whole bottle of this with power of no problem. what would be a good example? Give me just one. Mismatching used by corporation to advance their corporate interest or
Lobbying.
managerial interest.
Lobbying?
Lobbying. Lobbying shows up in financial statement. Yeah, that would be a promotional and marketing expense. Yes, I'm sure they put